Episode number 7, new week opening gap and new day opening gaps, right? What is the new week opening gap and what is the new day opening gap? A new week opening gap is defined by the closing price on Friday and the opening price on Sunday, right? Most of you are going to understand this. New day opening gap defined by the closing price of the previous day and the opening price of the new day, e.g., Tuesday's closing price and Wednesday's opening price, or Wednesday's closing price and Thursday's opening price. That gap, right? That's what we use. Okay, now new week opening gaps and day gaps only have two functions you need to consider. It's the same as the liquidity concepts. A level to target, okay, we can use it as a drawn liquidity, or a potential key level to trade from. We obviously have to build a framework and analysis using multiple concepts, which we're going to go over in this course, to determine how we will use the opening gaps. Okay, example. If bullish with a drawn liquidity higher and we have a new week or day opening gap below us in discount with sell side liquidity hovering around the level, we consider this as a key level for price to reverse from, and we can use it for longs just like we would in FVG, right? If bullish and we have traded into a discount key level and run out stops and we have a new week opening gap or new day opening gap above us, we can use that new opening gap as a drawn liquidity to target for longs, okay? Do not aimlessly map these out with no context and narrative. You must build an analysis with a bias before determining how we're going to actually use the opening gap. Are we going to use it as a drawn liquidity, or are we going to use it as a key level? Okay, an example here. Here is the Nasdaq. This is our discount low. This is our premium high. Here is 50%. We have SMT, okay, over here. And it's Thursday after a very bullish week. So we know with the open, high, low, close dynamics, we could potentially be creating the high of the open, low, high, close of a bullish weekly candle. We then have this new day opening gap, okay, and we're still in a premium here with SMT at a key time on a higher time frame chart, like a weekly is days, right? And here is equity open, right? So we want to target this as a drawn liquidity. Why? Because of everything I mentioned. We're in premium. It's Thursday. We're looking for shorts. There's SMT on the highs. We have already had an AMD here. We've respected this for a value gap. But now, what do you see here? Okay, think about the previous lessons. Relative equal highs, right? So if we're bearish, aiming for the new day opening gap, and we have relative equal highs above us, we see the relative equal highs get run here, and then the market sells off aggressively, okay? And yes, this is equity open right here, right? So you could be thinking we missed the move. No, I'm going to teach you guys in the short-term perspectives how we're going to be able to anticipate whether 930 will go directly to our drawn liquidity or if it will be a stop hunt. So you're going to be able to capture these moves as well. Okay, looking at a bullish example here, we have SMT with YM. Here's the Nasdaq with this low right here. Okay, so and in a bullish market, there's that SMT on YM. Now notice here, it's acting as both a drawn liquidity and as a key level, depending on the framework and narrative. In this case here, we've got one drive higher, two drive, and then the market sells off aggressively, right? We could be using this new week opening gap as a drawn liquidity here. Once we close below this down close candle here, we could be looking at the new week opening gap as the drawn liquidity, okay? And then we trade down into the new week opening gap. We have SMT, okay, with YM in a underlyingly bullish higher time frame market. We run out a short-term low, then we start to trade higher. It's a key level, right, that we're using for that narrative to trade higher. Okay, another example here, right? This was the new week opening gap. It set the stage for the low of the week, which it did. And then here is using a new day opening gap. We are bullish on the higher time frame. We've had that SMT. Everything is playing out perfectly. We trade down into this imbalance. Then we have this discount low to this premium high. We have a short-term low hovering around just above the new day opening gap when bullish, right? Making the new day opening gap very high probability to send price higher. And look at that reaction from the new day opening gap, right? Not random at all.